Hello, everybody. Happy Monday. Look, the market's opening flattish given the lousy economic news we're going to get this week. Is certainly, I think, a victory. I think the Abbott 15-minute test, the Johnson & Johnson news accelerating development of the vaccine, all of that is positive and goes right to the heart of what people need to see for a bottom, which is some progress on combating the coronavirus. So all of this is positive, and flattish, I think, is a victory. If you look at sectors, no surprise here. Healthcare is leading because of the good news we've got from some of the healthcare leadership groups there. Consumer staples doing well. Tech is okay. Underperforming are banks and retailers. Maybe not that surprising here. If you look at the stuff that's moving in the Dow, supporting it, it's mostly the healthcare stocks. So Johnson & Johnson, Merck, United Health. Abbott's also having a great morning as well, of course, on that announcement there. You see that big move up there for Abbott. Lots of notes over the weekend. A lot of people trying to figure out exactly what's going on and where a bottom might be. I think the important thing is we all agreed on the sort of criteria that we need. David Costin over at Goldman is as good as anybody else on this. Progress on containing the virus, that's the key thing. And we certainly saw good news today, and I think that's why we're flattish. Evidence of fiscal and monetary policy stimulus working, and a bottoming and positioning in flows. What does that mean? Well, it means how about lower volumes of trading activity, lower VIXs, things like that. We're still not quite seeing that. This morning we moved in a 60-point range in the S&P 500. Well, that's better than 100. We were doing 100-point ranges last week, so a little lower here. But let's watch these crazy moves that we've been seeing here in the last few weeks. Lower Goldman itself, Costin thinks so, lower in the coming weeks as we absorb all the economic data, but they're still up 20% by year end, 3,000. That's a 20% move from where we are right now. We could see the market swings in the last week, how crazy they are. Remember the lows last Monday? We were 34% from our highs. Then all of a sudden Thursday we had the enormous rallies and everybody saying suddenly we were almost 20% from our lows, and everyone was saying this game may be over, and we ended with a smack in the face on Friday reminding us about bear market rallies and things like that. As people brought out the history books in 2008, and now we're 15% off of the lows. So there is no clear indication from the market about what's going on right now. I think the key thing is to watch the VIX. I have spent a lot of time talking to people about what the VIX is telling us. The March average on the VIX is 57.8. That's Titanic. A year ago, the average was 14. So we're talking about a 300% increase in the VIX. The daily volatility in the month of March is about 5.5% on the S&P. What does that mean? That implies a VIX of anywhere, could be from 80 to 100. That's the actual volatility. If you measure the volatility of the VIX, actually 80 to 100. So these numbers are really elevated, and that's why I point out there's no chance anywhere that the VIX is going to drop much until we see this intraday, the actual volatility, the realized volatility drop. Take a look at the VIX where it is now. It's down a little bit. It was at the open in the low 60s, but people want to know what could take it to the 40s. We need to see intraday swings in the S&P down in the 2 and 3% ranges, not in the 5, 6, 7% ranges that we have been seeing all throughout the month of March. So there's your one thing that I'm watching. By the way, I did talk to the inventor, the founder of the VIX, Robert Whaley. You can see my interview with him, CNBC.com. He has his opinions on what the volatility index is telling us. Take a look there, tradertalk.cnbc.com for more on that.